Well, price action is the first derivative in trading. It's what we react to, it's what all indicators are derived from, and it's really the aggregation of supply and demand and all behaviours at any one time in the market. Now, introducing as part of Pepperstone's Master the Market series, we're looking at how to understand price action like a pro. Take it away, Ty and Tom.
All right, welcome everybody. Today we're covering a very important one that I'm sure everybody loves out there, which is of course mastering price action trading, naked analysis. One of my favorite topics, and I would probably say, Tyrone, one of the best topics out there when it comes to understanding markets and price action. It's just so important we get those types of things under our belt, and that really, if we understand price action, we have the beginning of a great confluence system.
It is, Tom, and yeah, welcome everybody. Look, price action is often underestimated, but really it is the true leading indicator that no one talks about. I mean, people talk about trying to get an edge with indicators, but the only real leading indicator is actually price, and naked price action really exemplifies what that actually is. So yeah, looking forward to getting into today because we're going to cover a lot of very, very important topics.
Okay, so Tyrone, I always get asked the same question, and it has to be, how do we better understand why price movements occur? And more importantly, is there an edge that we can gain from doing proper price action analysis? So today we're going to cover the 3 laws of Wyckoff, how to understand market price better, and then of course the composite man. What is it and how can it help you? One of my favorite topics. I know you love Wyckoff as well. He's the man, isn't he? And of course, he came up with this great quote here that we all love very much.
It is, yes. Successful tape reading is a study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. And really, when you think about that, and yeah, in today's markets, it actually really highlights what you actually need to do. And when you do see market action actually moving in a direction, you have to have that confidence to actually believe that's what the market is going. A lot of people spend so much time actually fighting what the market's actually doing, Tom, don't they? That they actually really miss the important actually elements of what the market actually is truly trying to do.
Yeah, sometimes they say, Tyrone, that simplicity is the best understanding. And really in this quote, we understand a lot about the market, but we don't just know it yet. So let's take a look together at what the 3 laws of Wyckoff were actually. The first one is the law of supply and demand. Now, most of us are aware of this. If you've done schooling or education or college or whatever those types of things, we all learn about the ideas of demand and supply. Basically, if demand outstrips supply, prices will rise. There's just a lot of demand out there, Tyrone. Everyone wants it. We've seen this in markets around the world, in crypto, and many times. We've also seen it, of course, in collectibles markets, such as watches over the last couple of years, and high luxury goods. The demand was so much that they were selling for more than the recommended retail prices, sometimes in 300 or even 400% times that amount. It seems unbelievable since they've started to drop recently. Then we have demand is less than supply, and of course, price will drop. Nothing new there. Again, just an amazing concept. And then we have the one that I always like to think about, demand equaling supply. And this means there's no significant price change and there's lower volatility. Now, Tyrone, that actually turns into, and the demand equals supply actually forms a pattern, doesn't it, in price action analysis? And what is that pattern and how important is it for us to understand when markets are in this type of area?
Yeah, absolutely. That's when we're going to see markets consolidating. And really, that's the opportunity to actually sometimes get in if you have actually missed out. And I think sometimes people try to jump on a train after it's left the station. You hear that quite often, and people try to do that. Understanding when supply is equaling demand is a very, very important concept, because this is the area where you can actually get in and join in either into a very existing trend or what may be the next move out. This is actually the area where ideally in a perfect world you are getting in, whether it's a swing trade, long-term trade, or even a day trade. These are the ones that you have to identify. But probably identifying these without knowing the tricks of the trade, Tom, can be quite difficult. So yeah, we're going to certainly highlight some of these tips today.
Yeah, so really when we're talking about the supply and demand side of things, what's happened is the market's come down, demand and supply are kind of in harmony, what we call equilibrium. And then often what will happen is after the market is sat for a level, a lot of people will think, well, that means it's going to bounce up and move up back to the previous price. That's not always the case. A lot of the time what will actually happen is it will consolidate. And what it's doing in this consolidation of demand equaling supply is often resetting the oscillators, and the indicators. So a little bit of information out of today's video would be, remember, when markets start to range bound, what they'll actually be doing is resetting indicators out there. And that's very important. Now, the next law was the law of cause and effect. And what this showed us was that it basically showed us that there was a difference between supply and demand, and they are not random. And instead, they came after periods of what we call market preparation. In Wyckoff's terms, a period of accumulation, which was the cause, can lead to an upward trend movement or the effect, and vice versa for distribution. To better understand this, Ty, if we go back to just the screen here, we can basically have a look at what this might look like. And we'll come back on the screen and basically we will show you what this may look like. The first thing is markets could come down and then they would effectively build a position, or they would equal demand equal supply. That was the preparation component. When the market breaks out of one of these coils, it is effectively the effect of that preparation. And once we understand there is a breakout of either direction, we are able to understand what this was. Was it demand or was it supply? If it breaks to the downside, it is what we call supply. If it breaks to the upside, it's what we call demand. And that means that if markets come back to that level in the future, there could be a very nice trade for us. And this is because the markets are prepared in these positions, a very large order. That order breaks out eventually. And then at that point, we know that if we've been patient enough, we can react to that particular position, can't we, Tyrone?
Yeah, most definitely. And patience is the key there, Tom. Once you do understand what you're looking for, you do have to be patient enough to actually wait for that trade to happen. You certainly don't want to be preempting where it's going to go, because quite often the first move is actually not the right one, and you really want to wait and be patient. We say it all the time, but it's really, really important, isn't it? Because if you do wait, more often than not, you're going to get, not only are you going to get the trade in, but you're going to get it at a far better level. You might say, well, if we got the break and it came back and tested it, went again anyway, we're still in. But realistically, you've had to endure a lot of what could be potentially market pain and potentially stop losses being taken out as well in that process. Patience is always going to help you when you're trading.
So then there's the last one here of his three laws, Ty, which was Wyckoff's third law stated that a change in instruments price were a result of an effort generally represented by trading volume. Now, volume is one of the best indicators in the markets, whether you're trading stocks, whether you're trading cryptos, whether you're trading even commodities or even currencies, volume can be an essential tool. So let's say a crypto such as Bitcoin started to consolidate with a very high volume after a long bearish trend. This high volume could signify a big effort. The move would be sideways, similar to what we've been talking about before, and low in volatility, but it would suggest that transactions were high and a reversal could be near. So an example of this would be, of course, that the markets come down to a price, that we see a huge build of a position, then it breaks to the upside. We now know that's demand. And what's been happening through this is as it came down, volume was high, but it remained high through the entire build process. So basically volume looked like this the whole way through. So the law of effort was coming through. Such an important one and often underutilized, isn't it, Tyrone? I think that is the biggest thing that I often take away from Wyckoff's three laws.
Yeah, it is. And I think that it's probably an underestimated tool volume. I know a lot of people say that it can sometimes be irrelevant if it's not really the correct volume. But when you actually see and you're dealing with a proper volume indicator, you know that you are actually getting that consolidation. And sometimes it can be very deceiving. If you're in a very low volume environment, the market can be actually quite volatile and tricky. So you actually want to see that. It is really ideal to actually see that volume build up and know that it's actually holding its own. Every candle or every bar that you're looking at has the same or similar volume than the previous one. So you know there's actually activity there. It's not just a flat market where nobody is interested. I think that's probably the key to it, really, having a market that people are actually trading, even though it's not moving aggressively in either direction, there is a lot of market movement there, and that's actually confirming the area.
Yeah, liquidity. Absolutely. Liquidity is being present in the market. Now we go to the most misunderstood, I would say, composite man, the way that Wyckoff made us understand markets a little bit easier. So everyone always asks, well, where are the biggest traders in the market? Where is Wall Street? Where are the big banks? I want to be trading with them and I want to know where their orders are. Well, what Wyckoff did was he created the idea that traders and investors should consider that a market was being controlled by a single entity. If we think about it as a single entity, then we can kind of think about it very simply. I always say, Tyrone, we have Cocoa Puff brains. That means we can't contemplate too many things at once, and we need to simplify everything. You know, some of the smartest people in the world, what they're able to do is they're able to take a super complex concept and break it down so that a grade 5 student can understand that complex concept. And it is so important that Wyckoff was able to do this. He basically said, think of all the price action as one single entity, and essentially the composite man represents the biggest players and the market makers, and it allows us as traders to better understand how potential market manipulation manifests in price action. And this is something that we're always looking for and striving to do in markets. So the next time that you see something like a range-bound market, really consider what is happening in terms of the indications. Is there the law of effort going on? Do we see a breakout of either direction? And what does that mean if market retraces back in after a breakout into that range? This is something I think most people underestimate when it comes to Wyckoff, Ty, and it's the most important concept of it all.
Yeah, no, most definitely. Understanding the area and knowing and really wanting the market to do a particular thing is the most important thing there. Not understanding what is actually happening is the biggest enemy in trading. So a lot of people say a flat market can't do anything. You have to wait for it to move. A flat market is actually telling you what is actually happening in that area if you understand it and apply the volume that we've talked about and some of these theories, because it really is trying to tell us something. It's telling us what it's about to do. We just have to know what it's. We have to know that it's actually happening. That's really the most important thing.
Yeah, we need to wait for that activation. Patience is the key.